As we step into 2025, inflation remains a key concern for global economies and investors alike. After years of fluctuating inflation rates, the effects of rising prices are becoming more evident, influencing everything from consumer spending habits to the broader financial markets. As the world adapts to post-pandemic economic shifts, inflation is expected to continue playing a pivotal role in shaping the investment landscape in the years to come. For investors, understanding the dynamics of inflation in 2025 and its broader impact on assets and market trends is crucial. In this article, we will explore the causes of inflation in 2025, its potential trajectory, and the investment strategies that can help mitigate risks and capitalize on opportunities in this changing economic environment. Inflation in 2025 and global economic landscape. To understand what inflation will look like in 2025, it's essential to consider the broader economic environment. Inflation in 2023 and 2024 has been driven by a variety of factors, many of which will continue to influence the cost of living and investing in 2025. 1. The impact of central bank policies. Central banks around the world, especially the Federal Reserve, have been actively managing inflation through interest rate adjustments. After aggressively raising rates throughout 2022 and 2023, many analysts believe that central banks will continue tightening policies into 2025, albeit at a slower pace. Higher interest rates generally curb inflation by making borrowing more expensive, thereby slowing down spending and investment. However, the cost of servicing debt is also rising for governments and individuals, creating a delicate balancing act. As central banks strive to stabilize inflation, they will likely focus on a more gradual policy shift, aiming for long-term price stability rather than immediate drastic cuts. These rate decisions will continue to shape the financial landscape in 2025, especially for equities, bonds, and other fixed-income assets. 2. Geopolitical events and global supply chains. Geopolitical tensions, particularly Russia's invasion of Ukraine and ongoing conflicts in other regions, will continue to strain global supply chains. The war in Ukraine has led to massive disruptions in energy supplies, agriculture, and raw materials. While prices for oil, gas, and food have somewhat stabilized, the long-term effects of supply chain imbalances are still being felt. For example, the energy crisis that began in 2022 could linger into 2025 as Europe and other regions transition away from Russian energy sources. This could keep energy prices volatile, contributing to higher costs across various sectors. Similarly, supply chain disruptions in sectors such as electronics and automobiles are still in play, leading to persistent inflationary pressures on goods. 3. Labor market dynamics. The labor market will continue to be a major driver of inflation in 2025. Over the past few years, global labor markets have been characterized by worker shortages, particularly in essential sectors. As companies raise wages to attract talent, higher labor costs can lead to price increases which further perpetuate inflation. However, in 2025, experts predict that the labor market may begin to normalize as inflation-adjusted wages start to slow and businesses find new ways to automate and streamline operations. Even though wage inflation might ease, the broader demand for skilled labor, especially in technology and healthcare, will still put upward pressure on wages in certain sectors. The impact of inflation on investments in 2025. Rising inflation impacts various asset classes differently. As inflation persists, investors need to be mindful of how different types of investments may perform. Here are a few key asset classes and how inflation could affect them in 2025. 1. Equities. Sector-specific performance. Equity markets, particularly in developed economies like the US and Europe, will continue to feel the effects of inflation. Higher interest rates can dampen the growth of businesses, especially those in sectors sensitive to borrowing costs like technology, real estate, and consumer discretionary. However, certain sectors are more resilient to inflationary pressures. For instance, consumer staples, energy, and utilities are likely to perform better because these companies provide essential products and services that people continue to demand, even when prices rise. Energy companies, particularly those involved in renewable energy, could benefit as global demand for sustainable energy sources increases. Inflation might also drive up commodity prices, benefiting companies in the mining, agriculture, and natural resources sectors. Moreover, infrastructure stocks may become more attractive due to the need for governments to invest in upgrading aging infrastructure while combating rising construction costs. Investors should consider diversifying their portfolios by adding more exposure to inflation-resilient sectors like consumer staples, energy, and commodities. 2. Bonds and fixed income investments. Bonds are traditionally seen as a safe haven investment, but their performance in an inflationary environment can be tricky. In an inflationary period, real yields, interest rates adjusted for inflation, become negative, which erodes the purchasing power of bond income. If inflation continues to rise in 2025, investors in traditional government bonds may see their returns diminished. However, Treasury inflation-protected securities offer protection against rising inflation as they adjust their principal value in line with inflation. TIPS can be an attractive option for investors seeking safety while hedging against inflationary pressures. Additionally, floating-rate bonds, which pay interest that adjusts with the market rate, could be an option for those looking to take advantage of rising interest rates without locking in low fixed-rate returns. Investors should explore TIPS, floating-rate bonds, or short-duration bonds to mitigate the risks of inflation in their fixed-income portfolios. 3. Real estate, a hedge against inflation. Real estate is another asset class that tends to perform well during inflationary periods. As construction costs rise, property values often increase, making real estate a natural hedge against inflation. Real estate also provides a regular income stream through rents, which tend to rise with inflation. In 2025, demand for residential and commercial properties will likely remain strong, driven by demographic trends such as urbanization and an increasing global population. Real estate investment trusts could be an attractive way to gain exposure to real estate without the need to directly own property. Real estate remains a solid hedge against inflation. REITs and direct property investments can provide steady income and long-term growth potential. 4. Commodities, a direct beneficiary of inflation. Commodities, particularly gold, silver, oil, and agriculture, are often considered a direct hedge against inflation. In 2025, gold may see renewed interest as inflationary pressures persist, with investors looking to store their wealth in a tangible asset that retains value. Oil and natural gas prices could also continue to rise due to ongoing supply constraints, geopolitical tensions, and the transition to green energy. Agricultural commodities such as wheat, corn, and soybeans may also benefit from rising prices as climate change and geopolitical factors disrupt supply chains. Commodities are often one of the best-performing asset classes during inflationary periods. Investors should consider gold, energy, and agriculture as part of their inflation-proof portfolio. 5. Cryptocurrencies, digital gold for a new era. Cryptocurrencies, particularly Bitcoin, have been increasingly viewed as a hedge against inflation. With Bitcoin's fixed supply and its growing role as a store of value, many investors have started to see it as digital gold. In 2025, Bitcoin and other cryptocurrencies like Ethereum may benefit from continued institutional adoption, especially if traditional financial systems are disrupted by rising inflation. Stablecoins could also play a significant role in stabilizing portfolios and providing liquidity during volatile periods. As traditional assets struggle with inflation, Bitcoin and other digital assets could become more attractive. Cryptocurrencies offer diversification and long-term potential for growth in an inflationary environment. Investment strategies for inflation in 2025. Given the expected persistence of inflation in 2025, here are some strategies investors should consider. Diversify across sectors. Avoid relying solely on traditional stocks or bonds. Instead, diversify into inflation-proof assets like commodities, real estate, and cryptocurrencies. Focus on income-producing assets. Look for investments that offer regular cash flow, such as dividend stocks, REITs, or bonds with inflation protection. Consider TIPS and floating-rate bonds. These types of bonds are less susceptible to inflation and can provide a safe haven in volatile times. Hedge with precious metals and commodities. Gold, silver, and other commodities can act as a store of value during inflationary periods. Stay flexible and monitor economic conditions. Inflation may evolve in unexpected ways, so it's important to stay informed and adjust your portfolio as needed. Navigating inflation in 2025. As inflation continues to shake the global economy in 2025, Investors will need to adapt their strategies to manage risk and maximize returns. Understanding the broader economic landscape, staying diversified, and focusing on inflation-protected assets will be key to navigating the challenges ahead. By focusing on real assets, inflation-protected securities, and commodities, investors can position themselves to thrive even as rising costs continue to affect the market. Inflation is a force that impacts everyone, but with the right strategies, investors can not only protect their wealth but potentially even grow it in an inflationary environment. Stay informed, stay proactive, and always be prepared for the next opportunity. If you found this video helpful, don't forget to like and subscribe for more insights on navigating the financial markets in 2025. Hit the notification bell so you never miss an update on inflation trends and investment strategies. Thanks for watching and stay informed.